Hi, this is Steve from Market Edge Australia. Today we're looking at how investors can use the S&P 500 bull credit spreads to generate income while defining their maximum risk before entering the trade. The product we're going to focus on is the SPX, the S&P 500 Index Option. SPX options are cash settled. They cannot be exercised early, and there is no shares or futures contracts delivered on expiry. That makes them a relatively clean instrument for trading defined risk option strategies through Interactive Brokers. The strategy we're describing is a bull put credit spread. This involves selling one put below the current level of the S&P 500 and simultaneously buying another put option at a lower strike price. The option we sell generates the premium. The option we buy defines the maximum potential loss. Before we look at an example, it is important to understand why we prefer using put credit spreads on the S&P 500. Over the long term, we are structurally bullish the index. The S&P 500 represents 500 of America's leading companies, including many of the largest and most profitable businesses in the world. It is not a static portfolio. Companies that deteriorate can eventually be removed and replaced by stronger businesses. Because the index is market cap weighted, companies creating the most value naturally become more influential within the index. Historically, the S&P 500 has produced long-term average returns of approximately 10% annually, including dividends. That does not mean it rises every year, and it certainly does not mean the market cannot experience major corrections. But over time, the index has demonstrated a powerful upward bias. A put credit spread allows us to take advantage of that upward bias without needing to predict exactly how high the market will go. We simply need the index to remain above the strike price of the put we have sold. Let's look at a hypothetical example. Assume the S&P 500 is trading around 7,500. We might look approximately 45 days out and begin searching around 5% below the current market. 5% below 7,500 is approximately 71.25. In this example, we could sell the 71.25 put and buy the 70.75 put. That creates a 50-point wide SPX credit spread. Because the SPX has a multiplier of 100, the total width of the spread represents $5,000. Assume we receive a credit of 7 points, or $700. Our maximum profit is the $700 premium we received. Our maximum potential loss is $5,000 less $700 credit, giving us a maximum potential risk of $4,300. The break-even point would be the short strike of 71.25 minus the 7 points credit, giving us a break-even level of 71.18. If the S&P 500 remains above 71.25 at expiry, both options expire worthless and we retain the full premium. However, this is not free income. Selling put spreads means accepting downside market risk. A position that begins 5% below the market can quickly come under pressure during a significant sell-off. That is why strike selection, position sizing, and risk management are critical. The objective is not simply to collect the largest premium available. The objective is to establish the spread far enough below the current market to create a meaningful margin for error while still receiving enough premium to justify the risk. Interactive Brokers allows investors to analyze the option chain, compare strike prices, examine implied volatility, and model the maximum profit and loss before submitting the order. SPX also offers extended trading hours, which can be useful for Australian investors. There may be opportunities to enter or manage positions during the Asian trading session, rather than waiting for the main U.S. market to open. However, liquidity and bid-offer spreads still need to be considered. A position should not be entered simply because the market is open. The key takeaway is straightforward. We are not trying to predict the exact direction of the S&P 500 over the next 45 days. We are establishing a defined risk position below the current market, collecting option premium, and allowing the index long-term upward bias to work in our favor. But the strike selection, position size, premium received, and maximum potential loss all need to be understood before entering the trade. This is Steve from Market Edge Australia. This is for educational purposes only. This is not financial advice.